Welcome to Cup of Bull. My name is Michael Dunham. I'm the Director of Planning, and with me today is Patrick Fontana, founder of the firm.
Welcome, Michael. Good to see you.
Cheers.
Michael, what is the biggest tax mistake that people make going into retirement?
Yeah, so we work with a lot of people who kind of enter this new phase of life where the hardest thing to wrap your mind around sometimes is understanding the change in your tax situation. You know, a lot of people, they're making the best money that they've ever made in their lives right before they stop working. And a lot of times they're in the highest tax brackets that they've ever been in. And then when you stop working and you start living off of your portfolio, it's not uncommon for those individuals to fall to much lower tax rates than they've been subject to in a very long time. If you've got a large taxable investment account that you're able to live off of, it's not uncommon for us to see clients or individuals with significant wealth who are now in some of the lowest tax brackets. And the other part of that is a lot of those people have done a really good job of saving, but if they've saved, I'll say, too much into the pre-tax retirement bucket where money that's taken out down the road will be subject to income taxes. When we project out what their required minimum distributions are going to be, which is essentially the IRS, when you turn between 73 and 75, forces you to take money out of your IRA or 401k account when you reach that age. And a lot of times for those individuals, they can be forced up into much higher tax brackets than they would have otherwise found themselves in based off of their lifestyle. And so we call this the retirement tax planning window, where somebody goes from a high income down to a very low tax bracket, but we know in the future they're going to get pumped up back into higher tax brackets. And the biggest mistake is not taking advantage of that.
So when we do our one-page plans, there's a section called asset location, and it's a circle. The red is pre-tax money, and it's fairly common that we'll come across a red circle where all the assets are pre-tax. And if we can get a hold of someone before it's too late and convert some of that to Roth, or at least have the game plan of when they stop working to make that transition and really take advantage of lower tax brackets, and that window, 62 to 70 kind of time frame before they're necessarily taking on Social Security, if they've got the ability to do some Roth conversions, it really heads off the train of that big tax bill and gives real planning opportunities.
Yeah, there's a couple of things that we say kind of end the retirement tax planning window. So one is Social Security. So this is a question we'll often get: when should I claim Social Security? And one of the reasons for delaying Social Security is it extends this retirement tax planning window. Social Security is partially taxable, and so if you claim that early, you're increasing your income and you're taking up some of these lower tax rates. Pensions is another example of a time that the retirement tax planning window can get condensed. A lot of times people get pensions that get turned on at 65. So if you are retiring before age 65, you may have a bigger window for the first couple of years until your pension turned on. And then the last one is what I brought up earlier, which is required minimum distributions, which for a lot of the clients that we work with who have significant pre-tax money, this can be the biggest impact of them all. It's not uncommon that when you project out later in life, these required distributions can be in the hundreds of thousands of dollars. And then the other thing I would add to this that's often not thought about is, average married couple, statistically speaking, one of the two spouses is going to outlive the other. And what happens at that point in time is the required minimum distributions, they don't go down. Social Security, the higher benefit sticks around. With a pension, some or all of that benefit could remain as well, where you can find yourself in a situation where income-wise, you're still very similar to what you were as a married couple, but now you're subject to single tax rates, which are often much worse than when you are married filing jointly.
So plan ahead, look at doing those moves, and avoid the big tax mistakes. Thanks for joining us today on Cup of Bull, and join us next time.
Rebalance until rich.
Rebalance until rich. Cheers.